Hello and welcome back to All Things Money. I'm your host, David Blain, and during this segment, we're going to start talking a little bit about healthcare reform and what it means to you. Of course, with the Supreme Court ruling and President Obama being reelected and the Democrats continuing to hold the Senate, any major changes to Obamacare are pretty much a moot point. So we want to make sure that everybody understands what is going on. There's been a lot of misinformation. As well as there's a lot of provisions that have taken place already. There are some that kick in January 1st, 2013, others that kick in 2014. And so we're going to start going through this with you. First, let's talk about what's coming January 1st. So you can start to plan. We've got about a month left in the year to kind of get you ready for it. Number one, and these are not necessarily in any order, just number one is limit on flexible spending accounts. Flexible spending accounts are typically set up by employees or employer provides it where you can put money tax-free into an account and use it to spend for things like health care. And since we're talking about health, you can spend it on other things like daycare and things like that, but we'll limit the discussion to health care. So for 2013, the government will enforce a $2,500 limit per employee that you can put in it. And so today, employers set their own caps, and in 2013, the government is going to tell you what you can put in your flexible spending account. Number two, the new Medicare surtax on investment income, and this is probably the most confusing one. It's where you see the most rumors that have been floating around. Oh, they're going to tax the sale of your house and things like that. That's where this comes from. It's a new Medicare surtax on investment income. And for 2013, first of all, it only applies to individuals who have wages and self-employment income above $200,000 or $250,000 if you're a couple. So, if you're below that limit, it's not going to apply to you at all. And so you're going to pay 3.8% surtax on the lower of the net investment income or the amount of your adjusted gross income above the $250,000 limit. So what that means is net investment income is interest, dividend, capital gains, rental income, things like that. And where the home confusion comes in is if you sell a house currently, as a couple, you can exclude $500,000 of profit from the sale of your home. As a single, you can exclude $250,000 from the sale of your home. So only in the event that you sell a primary residence and you make more than $250,000 or $500,000 on the sale would this Medicare surtax apply. So for the vast majority of Americans, this is a moot point, and it's not going to be a tax when you sell your home for most people. But it will affect those above $200,000 or $250,000, your interest, dividends, capital gains, things like that. Having a discussion last night with some folks that are in that category, over $250,000 a year income, and talking about some capital gains issues, maybe taking some losses because the rates are scheduled to go up 20%. You add on another 3.8% tax, and so the capital gains rate for people in the higher income tax bracket will go from 15% this year all the way up to 23.8%, plus, of course, whatever state tax that they may owe. Okay, number three, coming January 1st, an additional Medicare tax on wages and self-employment income. So currently, everybody pays 2.9% Medicare tax, 1.45% paid by the employee, 1.45% paid by the employer on all your income. Well, starting next year, they're going to increase, they're going to add another 0.9% on wages or self-employment income that is above $200,000 if you're single, $250,000 if you're married. So once again, this is a 0.9% on wage and self-employment income. So you've got these two new Medicare taxes, one on investment income and number two on wage and employment income. both targeted at singles making more than $200,000 and couples making more than $250,000. Okay, number 4, a higher hurdle to deduct medical expenses. Currently, medical costs are deductible to the extent that they exceed 7.5% of your adjusted gross income. For 2013, that threshold jumps up to 10%. So that means that, let's say your adjusted gross is $100,000. That means that the first $10,000 of your medical costs are not deductible. Okay, it's a threshold that you have to exceed. If you're over 65, it remains at 7.5% through 2016. Once again, they've got to put all these crazy exceptions in there. They can't just make a rule. It's got to be, well, now, it's an exception if you're over 65, and then, of course, in 2016, that rule goes away. It's absurd. Anyway, so those are the 4 main provisions that kick in for 2013 on the new health care law. Once again, a limit on the flexible spending account contributions to $2,500, a new 3.8% surtax on all types of investment income for singles making $200,000, married couples making over $250,000, an additional 0.9% Medicare tax on wage and self-employment income above that $250,000 threshold, and number 4, an increase in the threshold to 10% for medical deductions. When we come back, we'll continue talking about health care reform and what it means even further into the future.